XAU USD. An insane trading day. I'm about to break it down. We just made over $28,000. I think it was more than that when the final day closed, trading XAU USD. In this video, I'm going to show you proof that it was, as a matter of fact, on a live account. And on top of that, we are going to break down exactly how this trading strategy works so you can use it to trade gold better. Hey there, my name's Adam Winnig. In this video, we're going to be talking about an insane day we had on XAU USD, and I'm going to cut to the clip in just a second so you can see it, but I'll have you know that, again, this is not any sort of financial advice. This is also not me telling you that your results are going to be even remotely similar. Forex trading carries with it an insane amount of risk, as you know, but go ahead and roll the clip. Hey everyone, it's Adam here, and I just wanted to show you we're trading around the US election here, and it is quite exciting. Here is a live account. You can see live account. It says Davi's name, long story, but here's one of our live accounts, and you can see that today we have banked $4,000 profit, and we're also in about $25,000 in floating profit as well. Obviously, with all of the uncertainty around the US election, people are going to gold. And as you can see, gold has really been rising. This is one of our algorithms that is doing really well. This is called the Phoenix Portfolio. And yeah, you can see we just caught that huge gold move up. And hopefully, with all the uncertainty around the election, we'll continue to ride this move up and continue to bank more and more profits. But pretty good day, about $30,000 in profit for a day. Not too bad. Okay, so there it is. As you can tell, we had an incredible day trading XAU USD with one of our trading algorithms. And in this video, I'm going to break down some of the key components so that way you can start having these sort of trading days, or you can start using and incorporating some of these strategies. Now, what I will tell you is that we wrote an entire book about it. Okay, a friend of mine, he's now a partner of ours, was a real professional Forex bank trader for over 10 years. And so he got some interesting insight, and he actually helped us write this book called Edge Trading Secrets. So if you want to learn everything in depth about how to actually trade properly and are ready to finally find your edge, I'd highly recommend downloading that book. It's for free on our website. I'll include the link in the description below. Now, how did this actually happen? Well, what is the actual strategy behind how do you make $28,000 in a day? Well, the answer is that this was all done by our trading algorithms, which you can try on our website if you'd like to, but also let me break this down for you. The first thing that I want you to understand is you may be asking, well, Adam, what's the criteria for your entry? And everyone wants to get all caught up on entries. And the fact of the matter is that the entry is probably one of the least important components of a trading system. And so I'm not even going to get into speaking a whole lot about what the actual entry system is, because there's more important stuff that you need to understand, like the exit system. Now, the key here to why we had such a great day was because of something called fat tail rewards. Now, to really understand fat tail rewards, I got to take you back to statistics class really quickly and show you a bell-shaped curve, which you see right here. You've probably seen it. This is the median. This is one standard deviation and two standard deviations to the positive side. This is one and two standard deviations to the negative side. If you don't know what that means, then don't worry. I'll break it down really simply. Everything in life pretty much follows a normal distribution curve. If you look at birth weight, the average birth weight ends up being about 3.5. I believe this is in kilograms, correct? And then everything, you know, if you have basically, if you're 2 kilograms at birth, that means that's really, really highly unlikely. The vast majority fall within one standard deviation. So the vast majority of births fall between 3 and 4 kilograms. Now, it's also interesting because if you look at average income, then it's the same thing. It follows this normal bell-shaped curve with the majority of the data coming in within 1 to 2 standard deviations of the median. Okay, same thing with height. It's the same exact thing in everything in life. That's why this is confusing, okay? Because in trading, it doesn't follow a normal bell-shaped distribution. There's what's called fat tails. There's fat tail risk and there's fat tail reward. The fat tail distribution means that there's a greater probability of events producing outsized gains or losses. And this is the way that the market actually moves. Most people think that their losses and their wins are going to fall inside of this normal bell-shaped distribution, where on the left here is the fat tail losses and on the right is the fat tail rewards. meaning that, what does that mean? Well, at the left side, this is our biggest losses, and the right side, this is our biggest wins. And the reality is that there's these fat tails, and what fat tails do is this means that there's extreme movements in the market. And so the idea here, just to make this simple, is that we need to take advantage of the fat tail rewards, and we need to cut off the fat tail losses. Okay, so the big losses that most retail traders have, we need to cut those off completely, and we need to take advantage of the big fat tail rewards. And we do this by using things like trailing stop losses. So for example, in this particular example, what I was showing you guys was we were trading around the election, which was around like November 5, November 6 here. And you saw that gold actually had this huge plummet down. This caused us to get into the trade because we saw it was starting to form a downtrend. We got into the downtrend, but then we didn't just do that, but we actually just continued to trade and to trail our stop loss. So that way we were able to capture this fat tail reward. See, most people, they may have, got in like right here or something, for example, and then when it starts to retrace, they like get out of their position really quick. So they minimize their fat tail rewards. Whereas we just use a trailing stop loss and we continue to trail it as this goes on a down trend. So that's one of the ways that you can take advantage of fat tail rewards, is by simply using something like a trailing stop loss. The second key is that our trading system, it doesn't do well all the time. And I'm not going to claim to be that it does. During a ranging market, which can happen up to 75-80% of the time, where the market's just going sideways, we just enter and get out of trades really quickly. So we have really low, shallow drawdown. But when the market moves on these big, what's called levy flight distributions, or these big fat tail trends, when the market goes trending, that's when we make all of our money, is because we're actually trading with the trend. So my advice to you is to always trade with the trend no matter what. The next thing that our trading system does is it has a favorable risk to reward ratio. Unlike the vast majority of retail traders, it actually has a favorable risk to reward ratio. And I suggest that you do the same, because look at this data. We pulled in data from over 43 million retail trades, and we saw that Euro US dollar, for example, retail traders were able to predict a winning trade 61% of the time. And how are they always losers? How are the herd always losers? Well, the answer is because they have poor risk to reward ratios. If you look here, you can see that the losses were 70% bigger than their wins. The average losing trade was 83 pips, while the average winning trade was only 48 pips. So this is a key thing to understand. And if you look at the power of a one-to-one risk to reward, according to those 43 million trades that we took from retail traders, our data shows that you're 53% of all accounts that at least use a one-to-one risk to reward ratio actually turned a net profit in a 12-month sample period. And those under a one-to-one risk to reward ratio, only 17% of those traders were profitable. So you are 3 times more likely to be a profitable trader if you use a mere one-to-one risk to reward ratio, which of course our trading algorithms do. So to kind of summarize this and how you can actually catch the fat tail rewards and how you can have big trading days like this, well, the answer is it's not always going to be like that. But when the big moves happen and when the big trends happen, you want to make sure that you catch those trends and you want to ride those trends. Now, thankfully with gold, it happens to break out a lot. You'll see these big moves that happen on gold a lot. And that's why it's a profitable pair for us to trade, is because of these big moves that actually happen frequently. And then we use trailing stop losses to trail to make sure that we get to capture the majority or the most of we can of that big fat tail reward move, or what's called that levy flight move. And again, some of this may be a little bit foreign to you, the stuff that we're talking to you about. If you have not heard about this stuff and you want to learn more about this, it's all backed up by data and stats. It's not some theory that somebody made up online. This is real data. If you want to get more in-depth look at that, then go ahead, click the link in the description below, and you can go ahead and download the Edge Trading Secrets book. I promise you it's going to give you a massive breakthrough. And also, if you'd like to learn more about our trading algorithms, then I'll include a card here or video here that you can take a look at and have fun watching. Hopefully this is helpful, and we'll see you in the next video.